So, weekly mortgage demand has increased by 20%, or to be exact, 20.4%, right? After we've seen some little bit of a drop in the interest rates, right? So, this article that I'm going to talk about comes out from CNBC this morning. I'll link it in the description so you could read up on it. But I'll highlight just a couple of key points that the article mentions. The first key point is the average contract interest rate for 30-year fixed rate mortgages with conforming loan balances, the interest rate there decreased to 6.73% from 6.88%. So we saw a little bit of a decrease in those mortgage rates, causing the total mortgage application volume to jump 20.4% last week compared with the previous week. Okay, this is talking about on a weekly basis. And these numbers basically come out from the Mortgage Broker Association. This, and the article mentions also, this was not only the first increase in 3 weeks, but it's an outsized weekly move. However, even though you got that big jump in those mortgage applications on a weekly basis, and you have the decrease, the small decrease from 6.8% to 6.73%, it doesn't change anything in terms of true demand, right? What do I mean by that? What I mean by that is 6.73% is still high, okay? We still have pretty high mortgage rates if you're comparing back to the COVID eras, right? Will we get to COVID era? Well, there are few reasons or, catalysts that we have to see in order to get those rates significantly lower. But right now, if we don't have those catalysts, we're probably going to see higher rates for some time, right? And I'll talk about those catalysts later. But the biggest thing is we're seeing inventory move up higher when it comes to real estate, prices in certain areas being dropped, days on market for many of these houses increasing, right? Less demand from buyers, thus causing the inventory to also go up and the days on market to go up. So still, people, even though you got this weekly jump, it's just flashy news, and it's nothing really to tell you that, oh, the property market is now going to skyrocket here. We did get multiple rate cuts from the Fed, and just now we're getting the small decrease of 6.8% down to 6.73%. Doesn't that make you, a little bit, makes you wonder, why didn't we see that drop earlier when the Fed was cutting rates? And the reason for this decrease comes from the movements in the bond market. We're seeing the bond market yields come lower, the prices move up higher on the bond prices, and that has to do with the fear and uncertainty around all of this trade war and what the market perceives down the road, right? That's why you're seeing this mortgage rate move down. So this goes back to what I was saying multiple times on this channel, multiple times, many videos for year after year. Rate cuts may happen, but those aggressive rate cuts, really large slashes to the interest rates and your mortgage rates, will happen if there's panic in the economy, if there's something to be worried about. If not, it's going to stay where it is and maybe move slowly lower, but not to those COVID levels that we've seen before. So therefore, the reason you're seeing this little bit lower mortgage yield rates, the reason you're seeing that is because of that fear that I keep talking about. And what is that fear driving today? It's the trade war. It's the trade war. So we heard recently that Trump's going to go ahead with the tariffs on Mexico and Canada. This was a day, 2 days back. And we heard that, Canada's going to retaliate and so forth. And thus, we're seeing the stock market plunge and move lower on these fears. We've been seeing that, and that's causing the bond market to move up, causing those yields to come down. We have now the markets pricing in more rate cuts for the year for 2025, about I believe 3. Before, the expectation was 1 or none, and that's changing, and this will continue to change as new information comes out. Now, this morning, where we heard that U.S. and Canada are going to speak, as well as Mexico, and we heard yesterday that there's a possibility that these tariffs will be rolled back, or maybe speculation around that the extension will be another month, right, in April. We got a little bit of taste of that before. But then that was denied by Trump, and then we heard that he's going to go ahead with it, and now we're hearing that, okay, there might be some softness and maybe some kind of deal that comes through, right? So if that's the case, then we should see those bond yields move back up, actually. We should see those bond prices move down, stocks to move up on basically fears basically abating and going away. But if it doesn't, if nothing works out between US, Canada, Mexico, and fears creep back in, then you can see continuation of possibly the stock market moving down lower, the bonds prices moving up higher, and therefore those yields coming down. So those mortgage yields that have dropped slightly lower are being driven by the bond market. So regardless of what the Fed did previously with the rate cuts, didn't have much of an impact because the economy is good and fine. But now if there's fears about the economy, fears about what Trump's going to do, then that might be your open door ticket to lower mortgage rates, right? So it's kind of like a double-edged sword. And this is what I've been saying multiple times, and this is just a small little teaser and proof of that happening. That those mortgage yields, those rates, if they come down, especially aggressively, there's something wrong in the economy, some fears that the market and investors are seeing that may not be good for in terms of jobs, in terms of people's livelihoods, and so forth. So I know the stigma out there with the news and everyone's that, oh, rate cuts coming down, this is all good. Not necessarily. It does depend where you are in the business cycle, where you are in the economic cycle, and where we are right now is we've seen aggressive rate hikes in the past, where we continue to basically just trend sideways. We did see some rate cuts slowly. This generally tends to happen when it comes to the rate cutting cycle. After hiking aggressively, you got that slow rate cuts, and then if there's some sort of issues or fears, then you've got more rate cuts. If there's nothing to be worried about, then those rate cuts are not going to come anytime soon. The demand for housing, will continue to be slow. Those inventory numbers picking up, and also most importantly, days on the market will continue to be high, especially if everything's fine. Even though if the economy is still fine, right? Because you're not going to get those aggressive rate cuts all of a sudden. You're going to get those from the Fed if there's something wrong. And you're going to get that from the bond market if there's something wrong. So today is just a teaser, and this article is a teaser to show you what I've been saying this whole time. It can happen, or most likely may happen, and can continue on this trend only if you've got that fear event, that issue. So is it a win? you let me know, right? Are, seeing lower interest rates and a slash in those interest rates, aggressive one, is that truly a win? Is that truly a good thing? Again, depends where you are in the economic cycle, and where we are right now, it doesn't look like that. So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified in the next video, and I'll see you guys around. Cheers, bye.